Okay, hey there everyone. This video lesson right here is going to be a little lengthy, and I'll tell you why. Is because this is video number 2, trading only calls and puts. Again, I am referring to our boot camp section here. Where are we at here? Why is this not? There we go. Boot camp section right here, and this is where I'm at. Trading only calls and puts directionally. All right, directionally is the key thing. Shift draw. Sorry, I'm messing around with some new tools. Directionally. That's what I want you to look at. Directionally. Got to have a little bit of fun in the process, right? So anyway, trading only directionally, puts and calls only. If we come in here and let's just say I want to look at SPX. SPX is the S&P 500. It's pretty much the broad market indicator of how the market is trading. You know, obviously you watch the Dow and the Russell and the NASDAQ, but SPX I think is where we'll start, because if you'll see, you have tons of options that are traded every single week. I can come into this trade right here, 16 days until expiration, and I can right away identify two columns I want your eyes to look at: volume and open interest. 12,000 contracts have exchanged hands at this strike price on the put side. 9,000 have exchanged hands on the call side. Now, do you think there is any coincidence that there were 9,618 contracts traded at the 2,100 strike price on the call side and 9,118 contracts exchanged hands at the 2,105 strike on the call side? All right, that right there is only a 500 contract difference. That's a big trade, or that is, you know, several traders scaling in or out of positions, because you'll see there is so much open interest. It could easily absorb that amount of trading, but you'll begin to notice you want to trade options that have a lot of volume and a lot of open interest. So that's why I went to the SPX versus, you know, some of the penny stocks or something smaller. If we look at Russell, it's the same thing. There's lots of volume. There's not as much, okay? But you'll see a little bit narrower spreads. If you really wanted to get tight penny-wide spreads, let's go to the ETF, the SPY. Same thing, they trade every week. Now you've got 2 or 3 pennies wide. Same amount of volume, lots of contracts are traded. But I think for our illustrations here, I'm just going to talk about, well, you know, let's just talk about the Russell. So you will notice right off the bat here, if I want to trade in a directional opinion, straight calls or straight puts, if I want to go and if I want to buy this right here, why am I buying that, right? Why am I buying a call? Why am I buying a put? It's because you have an opinion about the market. And so let's say if I want to buy a call at this strike price, I know what my cost is going to be. You will never lose more than that cost. Most you will lose, if you pay $17 for this, the most you're going to lose is $1,700. Period. End of story. The market can go to 0. You will not lose more than that. Now, you have unlimited potential to the upside. So, you know, you can make 1R, 2R, 3R, 10R. And so you have that directional opinion. And when the market moves in your favor, that's when these options become incredibly powerful. Same thing on the put side. If I want to buy a put strike right here, I'm going to pay $15 for it. And I know right off the bat, if it keeps going up, I will lose $1,500. I have potential to make unlimited to the downside. All right. So when you start talking about spending time trading straight calls and straight puts, it's important to do that in a simulated real-time environment so that you can see how they operate, see how your mindset works. Because I want to show you something here. I'm going to bring over option view. It's a platform that allows you to step through in 30-minute increments at a time So you'll see 1234 was the last timestamp for the Russell. If I come over here and if I look at the Russell on a, let's do 30 minutes. Let's just do 10 days, 30 minutes. If I zoom in right here, probably this candle right here, it closed at 1233.49. All right, this one closed at 1233.82. So option view allows you to step through in 30-minute increments, and you'll say, okay, I can open up the Russell. I can get every single strike price. All right, these are the strikes that we were looking at. I can see how much it was trading for. And if I wanted to construct the same trade here, I went into Russell, and let's say I'm going to buy a call option at 12:30. Now it's 17:10. Well, I go right here, buy a call option, 12:30. Well, it's 17:05. So if I simulate buying one of them, you'll see that risk profile is exactly the same here, right? I've got $1,700 that is the most I could lose. Looks very similar to this. Okay, so what option view will allow me to do, and for those of you that may or may not be very serious about taking this really to the next level and becoming borderline obsessed with it, I think option view is a great way to accelerate that learning curve, if you will. So I could go back here to, let's just say January 1st. I could go through, well, let's just say Monday, January 5th at the end of the trading day. Okay, we'll go 30 minutes before it closes. This is Mountain Standard Time, so that's why it says 2 o'clock. I live in Arizona, so what I can do is I can say, all right, now the February cycle on this date had 46 days to expiration. Well, let me show you something here. If I go into, I'll go to the daytime here. Let's just say I want to look at this. Let's zoom in a little bit more. What is this date here? This is January 13th. So January 6th, it was a bearish day at the close. So let's just say I thought it was going to continue trading down. Let's just say this is what I'm looking at. I don't know what's going to happen next. And I think that I want to take a directional opinion that the market is going to go down. Well, I will come in here and I will say, okay, I think the market's going to go down. I could come right here at 1180, which is, where did the market close at on the 6th? Oh, we're on the 5th right now. Hold on a second. Let's go to the 6th. We still had a down day on the 5th, but what was the 6th? Another down day, minus 19 points down. So you can see that right here, right here, here's the 5th. We had a down day. We had another massive down day. It closed at right up here. Look at this area here. And again, this is reinforcing why you need to spend several days, weeks, maybe a whole month learning the platform. Look right up here where the C is. If I hover, close 1161.31 on the 6th. 1161.50. All right, close enough. A couple of pennies on the 6th. And actually, you know what? If I think I went to the end of the day, it would probably be exact. 1161.30. So you can see right off the bat, if I want to construct a trade that I believe is going to take advantage of a continued move down, well, then I'm going to go in, I'm going to take a directional opinion, and what happened after the 6th? It didn't go down. It absolutely turned around and went right back up. So completely wrong. Trade would have lost. And when you construct that trade here, if I went right here, I said I bought one put. I paid $37.05 for it. I convert it. I can see now if we move up along the x-axis here, it's going to be a 100% loser. If it moves down, well, then I have to decide how much profit am I going to be content with. So you'll see right here, it never moved down. I mean, that was pretty much almost the bottom. It rallied a little bit and it came back and tested it again, but then it took right off. So that trade would have been a loser. Well, you're going to learn how these options operate by just getting in here and trading them, okay? So let's say that I went the reverse and I said, well, I think we found support. I'm going to buy an option here, pay about the same price, $35.30. Now, it's completely changed that risk profile. I've got defined risk to the downside, unlimited profit potential to the upside, and you'll see that every day that this trade stays open, this is going to be a lesson we will talk about a little bit more in detail. I think probably I've dedicated a whole video to talking about the Greeks and their relationships, but probably video lesson number 3 in here, when I start talking a little bit more about skew and synthetic stock and some of these relationships, I want to start talking a little bit more about these Greeks, all right, because they are going to absolutely come up and you need to be aware of them. Now let's talk about them real quick now. Theta, that's the amount of time decay that you lose every single day. If it's negative, this is what you're losing. If it's positive, that's what you're making. So every day that this trade does not move in my favor, I'm theoretically losing about $38 a day on this trade. So if it's going to move, I want it to move pretty quick, or I want to cut it loose. But you'll see that obviously on the 6th right here, it did. It moved up. We had 2 days where it moved. So I'll fast forward to the 8th, go to the end of the trading day on the 8th. I will close this and you'll see I went from being essentially flat, break even. Now I'm up $1,700 on a $3,500 investment. In 2 days, I made essentially 50%, all right, or 0.5 R. And you'll notice that it didn't really move all that much in relationship to what it can move. So when you start trading directionally, it will add that element of how you trade currencies, how you trade futures, how you trade long or short stock. What point are you going to protect your profits and consider taking profits and closing the trade, or keeping it open and maximizing your gains? One big thing with options is there is that time element. This is going to expire in 43 days. So when you're buying long calls or long puts, they will expire. You have to be out of them before they expire. So just understand that this element right here, all right, right here, when this option expires, there's nothing you can do with it. It's over. Game's over. So at some point, you're going to have to close the trade. But let's say that we didn't. I'll fast forward a couple more days, and I watched my $1,700 profit drop all the way down to $700 profit. I just gave up $1,000 profit, potential profit. How is that going to make you feel? All right? You're not going to know until you're doing it, and that's why I'm encouraging you tremendously. Do it in the simulated paper environment. Take trades and see how you feel. See if you close them early and bank profits, or if you want to ride them as long as you can and risk giving up profits, because you'll see this option doesn't expire until here in this area here. So I'll fast forward to about the, maybe the middle of February and just show you we've got 40 days, 39 days until that option expires. If I just fast forward and say I did absolutely nothing to it until Friday the 13th, now that directional bet, that directional trade, that directional option that I paid $3,500 for, well, now it's worth $2,700. And we are way up here. You're not going to make much more than that. As this dotted line, as we get closer to the options expiring, becomes this expiration line. Okay, so the reason why I want to spend quite a few minutes talking about that is this software, this option view platform, lets you kind of walk through a little bit quicker, a little bit more rapidly than, you can see when I first started talking, this was trading for $17 and then went up to $17.10 and now it's $16.60. You can really spend an inordinate amount of time watching this to see how this is going to react versus, stepping through in 30-minute increments at a time. It just, all this does is accelerate the learning curve, and it helps you grab these concepts faster. There's no reason why in the world you can't you've got practice money here. Let's take this trade on Russell. Let's go take another trade on SPX. Let's take another trade on Apple. Let's take another trade on Priceline. Let's take one on NDX, etc. Right? You can take 4, 5, 6, 10 directional trades based upon your technical analysis skills or your fundamental analysis skills and see if the options will work. See if your directional opinion will have you learn how to make some money. Because what's going to happen is while you're doing that, you're going to learn in a real-time, first-hand environment how these options decay, how they gain value and how they lose value. And that's what I really want you to grasp, and that's the concept I want you to absorb. If you don't understand that early in the beginning, it makes no sense for me to start talking to you about how to trade condors and butterflies and straddles and calendars and all these other types of trades that you can practice those too if you don't understand the key components of why these options lose value, why they gain value, what kind of influences, let's just do this right here, let me just buy this, what kind of influences these numbers, these Greeks have on individual and option spreads. And when I say spread, all I mean is I'm buying one and I'm selling another. That's a spread, all right? You see it changes the risk profile. It lets me buy one, sell another, sell two, buy one, etc. You can construct a whole lot of different option positions based upon that thinking. But again, it all is going to circulate and come back around to you need to know how the value is gained or lost in a real-time environment.